This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, Bill Hamill.
I'm somewhat more comfortable collecting real estate than I am collecting other stuff.
This is the Collecting Real Estate Podcast. My name is Stephen Purse. I'm your host. Today I interviewed Jeff Davis from Bridgestone Capital. Great interview. Jeff has a very unique perspective on real estate investing and the industry as a whole because he is a logistics professional as well, which gives him a great insight into what the market's doing as a whole and where he thinks it'll go. And because of that, where rates will be, hopefully in a year or two. And we got into a great conversation. You know, no one has that perfect crystal ball, but he seems to have a really solid idea of where the market is headed. Jeff started with a single family home, and now he is involved with 1,100 units all through syndications. So if you're someone that's looking to scale up, looking to get into syndications, maybe also working that W-2 and hoping to leave that and become a full-time real estate professional in the future, this is a good one for you. Excited for this interview. We have Jeff Davis here from Bridgestone Capital. Jeff, thank you for being here this morning. Let's get right into it. Tell us how you got into the real estate market.
Yeah, absolutely. That all started, and I'll kind of back up. I landed in Houston, Texas back in 2005 after Katrina. Got into logistics, just kind of fell into a job at the desk level doing data entry and worked into a sales role. Finally got into a global sales position and started earning commissions and learned very, very quickly that that's a volatile position in sales. Commissions go up and commissions go down, right? So I wanted to earn and stabilize my income. And my research showed that the most stable way to do that and the most consistent income would come from rental real estate. And I began investing in 2015.
It's interesting because my first career out of school was in logistics and sales, and I did that for almost 2 years. And the whole time I was just thinking, how can I get into real estate? Because I'd learned in school that most of the wealthy people had made that wealth from real estate. So I was always in the back of my mind while I was doing logistics. And it sounds like you had a similar situation there.
Yes.
What was that first experience that you had with real estate?
Probably all the emotions, right? It was fear. And but I at the same time, it was kind of an adrenaline rush because you've got this property that you're now responsible for, and there's a mortgage payment and insurance and taxes, and I'm crossing my fingers that there will actually be a tenant who comes and applies and they will pay their rent. And when that happened, we got our first tenant 2 weeks after we had that house. So I literally on that property never made a mortgage payment without rent. I never paid my own payment. So that was an exhilarating payment.
Yeah. So was that a single family home that you purchased and then rented out?
Yes.
Okay. And was that your plan at the time to acquire single family homes or collect, if you will, and grow a portfolio that way?
Absolutely. My initial plan after that was to collect as many, since we're on collecting real estate, my initial plan was to acquire dozens and dozens of single family homes. And that has evolved over time.
Yeah, because what we always run into here as investors is capital, right? Where does that capital come from? Because it runs out eventually. No matter how much you have initially, you're going to run out if you keep buying. And single families can be difficult unless you're doing that primary residence loan. It's a little tougher to be creative with financing. It's harder to get that hard money or those syndication opportunities. What was your plan to keep acquiring these?
So it's interesting you say that. My plan evolved, and so I began to learn about wholesaling And through the wholesaling avenue, you work direct to sellers and you get cash for assignments, and hopefully you can find an ideal rental. I was not very good at wholesaling. Then I got into flips, and the flips was a good opportunity because you can get in and out of the properties. I got exposure and was built up my network for my contracting crew, and that even worked for getting into more rentals. What I did run into a problem of was scale, and I think that ties into the capital problem as well. But I'm only one person, and so I was finding deals, I was dealing with the contractors, dealing with tenants, and dealing with the banks. It was all falling on me. And so I just had a problem with scaling from the multiple properties, the multiple streams of incoming funds and outgoing funds, and managing my work and family life balance.
That sounds extremely relatable. Currently working with contractors and tenants and banks, and I know what you're going through, man. It's not easy. So are you still in the logistics industry?
I am.
Okay. How does that tie into your current real estate career?
It ties in. There's relatable factors from a corporate standpoint in dealing with clients, understanding communication skills. But what we know on the supply chain front is we see things about 2 years out, right? And everything that happened last year, we knew that prices were going to be in flux, and we also knew that there was going to be a lot of delays coming for quite a while. And so there was going to be some pain across the retail industry.
So you're telling me every real estate investor should make a friend in the logistics industry and then ask them what's coming next?
Yeah, I do field quite a few phone calls, and I do, I definitely in the projects that I'm involved in, I try to support as much as possible.
So on a day-to-day level, that helps you because you have a good idea of where prices and rates are going to go?
At least in my mind, yes. I definitely have my own theory, but I'm one man. Everybody has a theory about what's going to happen in the next 3 months and 6 months and 5 years and 10 years, correct? Everybody has their own theory, and I have mine.
10 years is pretty far out. I don't know if I have a 10-year theory. That's difficult. So fast forwarding today, when you have Bridgestone Capital, I'm guessing you're buying more than just single family homes now?
Yeah, I've stepped out of the single family. I am primarily focused on commercial real estate and really only looking at multifamily at this point.
What led you to
that? One of my lenders was, and we became good friends as he was a lender to me on my single family acquisitions. And as I was really just driving myself insane with all of the work, being home late hours, and after every project was still starting at ground zero, I was watching him and his partners get into their second and third apartment complex, and I did not see them coming home at 1 o'clock in the morning from a project dealing with contractors. And I, had a sit down with them on what am I doing differently than what you guys are, and so at that point, I knew that once I had disposed of all my assets last year, that I was going to move into that and kind of level up and get into the same mastermind group that they are a part of and follow those same steps and those same guidelines.
So you say he's a mentor for you?
He was a mentor and joined the same mentorship group. So just surrounded myself with the same people, the same mindset that are thinking bigger and have that same teamwork mentality.
I can't emphasize enough how important it is to one, have a mentor or someone who's been through it, done what you want to do already, and he can show you the way. And then also, like you said, to surround yourself with those like-minded people who have aligned interests, aligned
Yeah.
goals, and the mentality that they're going to make it happen. And they don't have those limiting beliefs because they have someone next to them who takes it away if it does pop up. What is your mastermind that you joined?
Jake and Gino.
Okay. Very familiar with the Jake and Gino community.
Yeah, well, Bill Hamill, right?
Yeah.
Bill Hamill and I were in the same community, and I see him a lot. He's always out there with his running and his events. And I've seen him at several Jake and Gino events in Arizona, and I saw him in Austin.
Are you going to Orlando in November?
I have decided not to.
Okay.
I was on the fence, but I'm going to go to another one that they have in December.
Okay. So, yeah, I mean, this isn't a Jake and Gino ad here. We like to say no free ads, but this is a free ad. If you want to scale into something, surrounding yourself with other people who are already achieving those goals, that's going to be your best way to get it done. So you joined Jake and Gino. You started learning about multifamily. I'm guessing you started learning about syndications. Where are you today? What are you looking to achieve now as far as real estate investing?
Yeah, I'm at so I'm a limited partner in about 500 units. I'm a general partner in about 600 units, and we should find out today if we got an offer accepted. I feel very confident. The group that I'm working with now is so fun. We all are using our skill set and to our best ability. And we're really getting to a point where we're singing from the same song sheet and working on so many deals that it's going to happen. And we finally, we've probably underwritten 100 deals this year, but at this point, I feel like this one we're probably going to lock up. We should find out today, like I said, and we have about 10 more in our pipeline. And it's just, we're getting to a point where we're cutting 2 to 3 LOIs per week. And we have a pipeline of 10 to 15 that go through a process before we submit an offer.
1,100 units. That's a far away from a single family.
It is, and there's a different position for each of those. And so you got 500 that I'm a limited partner. So that's just vetting the sponsor and investing and getting a check and equity. And so then I'm a co-GP on the remainder of those. And that's a matter of going out and having investors invest in a property that I've vetted out the sponsor, and they get the check. So basically they get all the benefits. A limited partner gets all the benefits of being a landlord without the headache of finding the property, of doing the rehab, of getting maintenance calls, of having a tenant walk out on them, of chasing down rent if they're a couple of days late, paying the bank mortgage. So a limited partner investor gets all the benefits of being a landlord by simply you get the equity of the property, the equity appreciation, you get the tax benefits, but you do not have the headaches of sourcing the property, maintaining it, getting the calls from a tenant, finding a tenant, and collecting payments or worrying if your tenant's going to pay. You allow that to the general partners and our management team. So that's a fantastic benefit and certainly a way to diversify somebody's portfolio out of a stock market or even using a self-directed IRA. That's what we've been able to do, and I've been able to work with a lot of different investors, and it is really nice to send out distribution checks.
Absolutely. I think being a limited partner is the best way to passively invest in real estate. You have a little bit more control and say than a REIT because you're really vetting that sponsor, but it is passive. People say, I'm going to buy a duplex and passively generate income. That's not passive. Even if you have a manager on it, that's not passive. Limited partnerships do provide that opportunity. You briefly mentioned the different members of your team having your roles, having your own skill sets. Can you go a little deeper into that and explain how your team works together?
Absolutely. And this is a part that takes time, and this is the importance of networking. I'm a salesperson. I have spent many years learning sales, and my my value add is going to be in a deal sourcing role, um, building relationships with brokers who are kind of the first line of defense to a real estate transaction in the commercial real estate world. I'm a networker by trade, and I build relationships very easily. I'm a talker. I'm an extrovert, and many times I can go into a room and I have no problem meeting people and making new friends. Um, I am not a strong underwriter. So I enjoy looking at it and analyzing deals, but in terms of doing a deep dive underwriting, and so that's not a strong suit for me. But I have met people through our Jake and Gino community where they're engineers by trade, and this is their strong suit. But going and making cold calls and introducing to brokers and networking events is not a strong suit, but underwriting, yes. And so that combination has really proven very beneficial where, they'll call and say, let's get that pipeline going. However many deals, Jeff, you can put into the CRM is how many deals I can underwrite. And then I go get that feedback from the broker, and it's a continuous cycle. And then the brokers start to understand that we're real players. And, of course, we've got backing from big sponsors from the community who have closed deals, and they are our sponsors. So that's everybody playing their role.
Yeah, but when you first realize, hey, I can just cold call and find deals and you guys will take care of the rest, that's amazing, right?
Yes, that's that's amazing, right?
Yeah.
This is what I love to do,
Mm-hmm.
and I don't have to do the part that I'm not good at.
But you mentioned having 2 or 3 LOIs a week, 15 in the pipeline. Those are pretty big numbers if we're talking, larger assets here. How are you able to maintain a lead list like that, a pipeline with that many leads, while also working in logistics? I think we have a lot of listeners who are, dipping their toes into real estate, but they are still working W-2. How do you manage both of those things as well as a family and a personal life?
That's a good question. I'm still trying to figure that out. So I would say, part of what I have is a virtual assistant who manages kind of my marketing aspect on the capital raising side and my social media. And I'm calling all the time, right? So I call a lot. And my partners and we talk a lot. And so just because a deal goes into the pipeline does not mean we are going to underwrite it. And so we're constantly evolving our buy box. And so if somebody from the team puts something in there, let's say it's in Dallas, that's not my backyard, but we check with, I'll check with her. What is this area?
Can we pause here? What's a buy box?
Yeah, so our buy box is our initial screening criteria of if a property is going to be a go or no go, right? So we're getting into stages of, does this fit our buying criteria, and will investors want to invest? Are we going to want this property? Because if we're not going to buy it, then we don't want to underwrite it.
Mm-hmm.
And so initially we're going to put it at the top of the funnel. But we've got some very quick screening processes that will eliminate it. If this is a $100 million opportunity, likely we cannot close on that property, and we'll give that broker the feedback and tell them we just can't do that at this point in time. If this is a a fire-torn property that's in a really bad neighborhood in Denver, Colorado. Well, we're all in Texas, and that's kind of our backyard. And we don't have a contracting crew and all of these resources in Denver. I just don't know it. We're going to pass on that. So we can very quickly eliminate and get properties that are more catered towards our buying criteria before we start doing deeper dive underwriting.
So important to have that criteria clearly defined, so you're not just having that shiny object syndrome, running around in circles, not
Right.
submitting those LOIs.
Yeah, it is a buying criteria. It's understanding the neighborhood, and maybe we think the neighborhood is good at first. So let's go ahead and do a deeper dive. But understand, what are you going to be able to close on? If this is a big property, can you raise the capital for the rest? If yes, move forward. If no, don't. Pass this on. Everybody has a lot on their plate. So don't waste our time or the brokers doing things that is not going to be a yes at the end.
And you're mostly sticking to that Texas market?
For now, yes.
I was thinking you bought a single family in 05. That probably did pretty well. You sold that recently, I think you said last year.
It did really well. Yes.
The Houston market's
all of
done.
my properties, I exited out of my last property sold in September, less than a year ago. Just over a year ago, last September. So I got out right as the market peaked.
It's great. So what's some other criteria you're looking for? Are you looking for in these highly urban areas or more suburban, secondary, tertiary?
Yeah, it's interesting you say that, because I just was late last night looking at there's two properties we're looking at, and I think they'd be considered tertiary markets. And so that's going to be a conversation between us and one of our lenders on how the lenders view that. So we're not opposed to it. I'm not opposed to it. Just going to be depending on the debt. So we're looking at basically everything we're looking at is agency debt, but there's a flood of loan assumptions right now. There's a lot of loan assumptions. The deal that we're looking at today is also a loan assumption, and the pricing, the rates are very competitive. If you look at these loan assumptions, ones that we've looked at are under 4% fixed.
Wow.
And so you try and make that work, right?
Yeah.
It's very good to try and make that work. As long as the seller is not trying to make it uncompetitive.
I think we'll see a lot more of these loan assumptions moving forward as the rates continue to rise here. Do you have any other debt predictions or loan suggestions using your logistics crystal ball?
I do. I'll start off with the prediction. My prediction is that the interest rates will start to come down about 1 year from now. And that's based purely on a supply chain reasoning and using that metric and backing out, then the Fed would start reducing, right? So to give the big story, to give a broader example with some information to back that up, in the logistics world, we all saw these prices going 10x, right? So if a container from China to Houston was $2,500 to $3,000 forever, right? It has always been that. Over the past 18 months, that price skyrocketed to around $28,000. So if you are a company, right, if you are Steven LLC and you're used to importing 100 containers, well, your budget has always been around, $3 million. I hope I did that math right. If it was 300 times, or I guess 100 times 3,000, 300,000. You just watched your budget just for transportation blow up to 3 million from 300,000. And so companies all over the US experience this, and in Europe, they experience the same thing except on a wider scale. And the problem here is that the consumer didn't feel this. The consumer didn't feel these price increases until Q2 of this year. That is when we began to hear about inflation. So all last year, all 2021, prices were getting increased to the business, not passed on to the consumer. By Q2 of this year, we started to hear, hey, 5% inflation, 6, 8, 9% inflation. Well, in June of this year, pricing dropped from $28,000 a container to $15,000. And at that point, I began to project that in November of this year, we're going to be at pre-COVID levels. By just last week, containers were at $5,000. So using that math, we're going to be at about 9 to 12 months before these reduced supply chain costs hit the consumer level. So from, let's say, June to next June, right? 12 months of reduced supply chain costs hitting the consumer level. Finally, that eases on our pocketbooks, right? Because we're all spending more. I mean, it's a lot more at the grocery. The Fed looks back when they're judging what interest rates need to be. They're always looking at 3 months prior. So until they start to look at 3 months prior what costs are to the consumer, the CPI and all of these data points, well, when they look at next June, which will be in July, they're going to start kind of rolling back some pricing and rolling back some interest rates.
It's really interesting stuff. We don't talk about, container shipping being the one that's affecting your prices as a consumer, but it seems like there is that direct relationship there.
And you know what? The reason is because typically it hasn't, right? It never was, because in the example I gave you, most businesses, it's just a line item. And if it's just a line item and every year it fluctuates between 100,000 and 150,000, it's no big deal. But when that line item skyrockets from 100,000 to 2.5 million, it's a big deal. For me personally, I went from meeting with the desk clerk to the CEO. All of my meetings are with very, very high level members and executive boards because of the supply chain.
For your first example, it seems like if you have a business where your shipping costs are 300,000 and the next year it's 3 million, that might put you out of business. Such a big change.
Yeah.
And this isn't a logistics podcast, but this is really interesting stuff.
Yeah, correct. Right. And then there's the flip side of that, where it's not that spending more got you the material that you needed for your customer. Right. And we always think retail and Amazon. I don't deal in that world. I deal in machinery and oil and gas. But, if you don't get the stuff for your customer, then A, they're looking somewhere else, or B, they don't get it. And this XYZ project doesn't happen on time, and then there's delays. So convey that to a real estate project, right? Where we've got a 300-unit apartment complex. We're going to need cabinets to refurbish all of them. Well, all your containers are on the water, and or the factory hasn't approved the PO yet. And these things are months delayed, and they're 10 times as much.
Putting cabinets into 300 units sounds like a nightmare. I'm doing it in 5 right now. That's hard enough. Would you say that huge increase in price in shipping was solely due to COVID?
Yes.
Okay. So as we back away from that pandemic, we should go back to what you consider normal.
Yeah, and that's my point, right? Is we're in what's called peak season. We're in the high cost shipping season right now, and it is going down. It is dropping at precipitous rates. And because the consumer demand isn't there, inventory levels in the U.S. are at all-time highs. We're really hitting a normalization trend right now. There's still problems. Don't get me wrong. There's a lot of issues in the supply chain. All the bottlenecks are not gone. Another black swan event just occurred with the hurricane in Florida, and God bless everybody there. But things are getting normalized as capacity opens up and demand goes down.
Oh, I was going to say capacity's up. I want to put my logistics hat back on. Shout out to Blue Grace. So if we could get really specific here, you think that the Fed's going to start lowering rates again, probably about a year from now. How low do you think they'll go? Do you think we're going to see sub-3 rates again? Or am I never going to see that again in my lifetime?
I wouldn't say in your lifetime, but I don't think that's likely. I don't want to pinpoint interest rates where they'll be, but we're at a point now where I actually started buying real estate 7 years ago. It's probably it's a notch higher, but where it's been on a tear for 7 years and really the past 3 years, it's what actually makes me bullish.
Okay.
Because we'll be normal where home buyers, they give that little notification to the broker. Yeah, you're in my top 3. So we're in a normalization period where properties sit and they take some time to season, 30, 45 days on the market. And buyers have some time to look. Banks have time to vet their buyers and their loanees, their borrowers, excuse me. And when interest rates drop, prices typically rise, right? So I kind of want to acquire all of the properties right now.
I like the way you think.
Yeah.
And of course, no one knows what exact rate we're going to have a year from now, but it's a fun conversation to have because it's so important for what we do every day.
I haven't thought about trying to pinpoint an exact rate, but that would be something different.
If you're able to do that, let me know.
I'm not an economist. I am not an economist, right? I just am trying to put, some predictions out there.
Yep. What do you see for Bridgestone Capital in the next year, 3 years, 5 years? What's your goal? What's your plan?
The plan is definitely heavy acquisitions over the next 12 to 24 months and beyond, right? We're probably going to change a little bit of the acquisition strategy into different fields of commercial real estate, but that's not for another 3 years. But over the next 2 years, we're in acquisition mode, and we'll probably be joining forces with some other team members that I've mentioned, right? There's nothing formal there, but we're heavily looking. We're aligning with some strategic brokers to ensure that we get off-market deals at the best possible price for investors. And we're really enjoying giving investor returns and returning the most shareholder value, the most investor capital as possible.
What are some of these other commercial asset classes that you're thinking about in a few years, and why?
I like the warehouse space, and I think primarily because we're in Houston, we're by the ship channel. I come from a logistics background, so I can speak warehouse, and a lot of my investor base comes from a logistics background. So it's something that we can all speak to, and it's something that we can all understand at our core. So that's definitely something I'm researching, and that I can see us going in that direction.
Yeah, that makes sense. A lot of opportunity in warehouse space. Jeff, I want to respect your time. You're a real estate investor, a logistics expert, a quasi-economist. So I know you have a lot going on. We wrap this episode up with 3 questions because they say to have a collection of something, you have to have 3 of them. So we have 3 questions for you. The first one, in 5 words or less, what's the most important thing you've learned since you started collecting real estate?
Oh, most important thing I've learned. You can never account for everything. There's always going to be a surprise.
I like that. It goes along with you don't know what you don't know.
Yeah, I think that's a better way of putting it.
That's so true.
You don't know what you don't know.
Yep. A second question. What are your 1 to 2 year personal goals outside of business?
That's a really good one. I have 5 kids, so my goals are always wrapped around them. So my goal is just to be here as much as possible for the kids. I used to travel quite a bit, and so with the real estate, I get to stay home more.
That's great. And you're planning on going more in the real estate direction in the future?
Full time.
Yeah.
Yeah, I have a date in mind.
We'll say that
So
for
that
the
would
next
be
episode.
my 2-year goal, right? Yeah.
Okay.
June 2024. That's the goal.
I think you're well on the way there. Third question. How can the listeners help you and how can they contact you?
If you know anybody that is interested or has expressed an interest in investing in real estate, investing in Texas, and just wants to learn a little bit more about it, reach out, download our white paper, 7 Reasons We Like Multifamily. That is at bridgestonecapital.com.
Awesome. Thank you, Jeff, for being on the show. I think this is a great episode. Looking forward to the next one.
Awesome, man. Thanks.